Good Friday to everybody. I hope you had a great week. It was a little bit of a short week in the world of bonds and the stock market, but we still saw some little nice improvements. We're still in a good trading band. Three main things that are really going to influence rates over the next couple of weeks. First and foremost is China. On March 1st, the lull in the trade war is going to be over. There's a 90-day lull in it. If we don't see any trade deals or an extension, another 25% tariffs is going to go in effect on $200 billion worth of China. This will probably cause the stock market to go down and interest rates to go down too. But on the flip side, if we see a decent trade deal with China, and it's not a crappy trade deal like we had with Canada and Mexico, we could really see the stock market rally. We could really see interest rates worsen. Second of all is recession. The Federal Reserve is ultra cautious right now. They've used the word patient more times than I have ever had with my children. And they are indicating, there's a potential recession 2020, 2021. Obviously bad for stock market, bad for employment, good for interest rates though, because during a recession, interest rates drop. Last, that's not really getting a lot of attention, that should be getting attention, is Brexit. If United Kingdom does not exit out of the European Union in a good way, it could cause them to go into a huge recession, and that could have influence over us. So let's take a look at some numbers real fast, and we'll talk about those. This week, we had a shorter trading week. We still are in this trading band where we're at the 4.25 up here. We're at the 4.5 right in here. So we're really sitting at about 4.375 on a conventional rate for good borrowers. That's where I locked a loan today at a 4.375 on a 3-day lock. So we're really seeing this standard trading for quite a long time, actually all the way since January. So still got great rates, still in a floating mode. This will be floating until something comes out about either China or Brexit. Going into the recession, we had jobless claims come out this week. Jobless claims dropped, which is really nice. We'd seen them jump up from this was actually 199, this rounded up to 200. Jumped up to 253, which we thought it would based off of the government shutdown. Stayed kind of high and then it dropped back down. We would really like to see this drop back down under 215 in that 210 range. Because this is an initial indicator of a recession when people start laying off their clientele. So this is pretty good. So right now we are still going to be sitting in a lock mode. We still anticipate rates staying in this trading channel here. And unless we get some really good or bad China news, or something really happens about Brexit, we don't anticipate it coming out of this trading band anytime soon. A pretty spectacular thing, or a graphic to give out each and every month to your clientele in your database, is produced by the Boise Regional Realtors. They do a great job of publishing data on Ada, Canyon, Gem, and I believe Elmore County each and every month, and they give you some really good social media shares. So if you are looking at this, the Boise Regional Realtors, I'll put a link. This came out on February 12th, so it actually came out over a week ago. But it gives you some great takeaways, so you can talk to your clients and talk to potential listing appointments about what's happening in the communities. And then it gives you some great social media shares. Here's the one for Ada County. It's a great social media share, gives some really good information about what happened in a month-over-month and year-over-year snapshot. A lot of agents will publish it, not as many as I think should be publishing it. And also I see a lot of companies taking this data and molding it into their own infographic. But this is a pretty nice little infographic here. The one that I like to use is if you go back to these infographics and you click up in here, this is actually more of a data infographic, and I'll utilize this. So like in Ada County, we saw closed sales decline 18%. But the median home price was up 11%. Days on market increased. Pending home sales were down. The nice thing about this report is it really drills down some good data, and it puts some of the good data into perspective on individual houses. And then you can look at existing resale. So you can scroll through here. The existing resale graphic I really like to use because I get a lot of people that ask, when is it a buyer's market and when is it a seller's market? And you can see here that based off of closed sales, that obviously January's are seller or buyer's markets, and May, June, July are buyer's markets. And you can see that is a lock and load statistic all the way back to 2007 pretty much. So what I highly encourage you to do is take one of these infographics, post it on your social media. You should have a Facebook account, a Twitter account, an Instagram account, and a Pinterest account. And make some remarks about this and get it out to clients. And then also don't forget to ask for the business. Hey, here's all the information. If you want to know more about putting your house on the market, call me. I'll gladly help you out. So great tip for you to do some social media. I'm going to put a link down below. So you have that link. I would save that link to your bookmark bar. And then, like I said, about mid-month, 11th, 12th, 13th, Boise Regional Realtors publishes this. Great news. Last, I'm going to talk about credit inquiries. We get a lot of questions on credit inquiries and when it is good and bad to have multiple people pull your credit report. So overall, there's two different types of inquiries. There is a hard pull and a soft pull. A soft pull would be somebody that's inquiring about your credit report that is going to offer you a service, not credit, but service. This would be like a rental company. This would be your car insurance. This would be your employer. These are soft pulls. These do not affect your credit report and do not drop your scores down. On the flip side, we have hard pulls. So mortgage lenders, we do a hard pull. A hard pull is typically 3 points, and it affects each of the 3 credit bureaus. So what's going to happen is mortgage company, I'm going to pull your credit report, and it's going to ding you 3 points. The nice thing about this is for the next 30 days, you're allowed to shop mortgages. So the industry says you're allowed to have individual mortgage companies shop your loan around, which is great because you should shop your loan around. More people shop their loan around, I'd be significantly richer. So what's going to happen is First Choice Mortgage is going to pull your credit report, and then XYZ lender is going to pull your credit report, say, a week later. XYZ is, even though it's a hard pull, because it's designated as a mortgage, it is not going to affect the FICO score. So the FICO score isn't going to drop another 3 points. You can have as many lenders as you want within the 30-day calendar time period from the initial pull to shop your credit report. Now, on a car loan, you're allowed to shop for 15 days. So if you've ever gotten a car loan and seen your credit report afterwards, you'll see the dealership will pull the initial credit report, then they send you off on your car, and then they pull it like 20 other times and trying to find a better deal or ways of getting more money for the dealership by selling that car loan to that particular lender. So you're allowed to do that for 15 days. On a credit card, you're never allowed to shop for a credit card. Every time you pull a credit card, it's going to ding you those 3 points. And the reason for that is they don't want somebody going out and getting 15 credit cards, racking them all up, and then jumping down to Belize as a retirement plan. So moral of the story is, yes, you're allowed to shop for a mortgage. You're allowed to have multiple lenders pull your credit report during that 30-day time period. And then after the initial credit report is pulled and you've dinged 3 points, you actually get those points back in 90 days. So 90 days after that initial, you'll get those 3 points back. And the reason for that is credit reports are only good for 90 days. So if we have a new construction and we're going to pull that credit report, say January 1st, but the home isn't going to be done until August, we're going to pull the initial credit report, and we're not going to pull another credit report until we're 30 days from closing. And we pray that the borrowers have not done anything on their credit report during that time period of new construction. I hope this answers some questions for you. If you have any other further questions, please don't hesitate to give me a buzz. I'll be gladly to explain it out to you. Thanks and have a great day.